The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A bit of an equity wipeout amid a bit of an inflation resurgence. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele, and we're kicking you off to the closing bell right here in the U.S. An ugly day. It looks like we're going to end up here at this point.
Yeah, a big turnaround from yesterday.
Yeah, turnaround Tuesday, but not in a good way. S&P now down to the lows of the session, down 0.8%. You have the Mag 7 also really helping to lead the way lower, down by over 2%. NVIDIA actually the underperformer within that space, and yields really propelling higher on that back end by about 5 basis points now on the 10-year. I'm going to say it is a good news for the market, good news for the economy, bad news now for the market, Romaine.
Yeah, and it's kind of interesting, too. We actually came into today with equities actually pointing to what was going to be a third straight day of gains, Alex, but that actually changed in a big way about 30 minutes into the trading day when the Institute for Supply Management said an index of inflation in the services sector that rose to the highest in almost a year. That acceleration adding to concern that inflation is and will remain stubborn.
By the Fed's own take, they've indicated that they're expecting inflation is going to be higher than they previously thought for longer, and they need to take action.
And of course, Charles Evans would know. In fact, as of today, bond traders have ceased fully pricing in a Fed interest rate cut at all for the first half of this year. Yields across maturities higher today, led primarily by the 30-year, which is interesting, up about 13 basis points now above where it started the year. And this actually circles us back to equities, which are still sitting at elevated valuations, which means even the most minor negative news can tip them over, like we're seeing today. Case in point, NVIDIA, the rocket ship of a stock with a rock star for a CEO, plunging the most intraday in about 3 months as Jensen Huang's CES presentation left more questions than answers. Questions about the Blackwell chip, questions about corporate partnership, and questions as to how sane it is to pay 56 times annual earnings to own the stock. In fact, if you took NVIDIA's current market price and instead invested that $143 in a benchmark treasury, you would earn almost $7 of interest income based on current yields of right around 4.67 or so. That compares to a $2.60 return for investing that same amount of money in NVIDIA based on a current earnings yield of about 1.8%. A reminder that valuations, Alex, and value itself are always relative.
Yeah, that's such a great comparison because we hear that a lot in the broader equity market versus the 10-year Treasury. And here is a great case in point. This is the S&P forward earnings yield minus the 10-year Treasury. So the idea is when you're in the green, it means that equities are undervalued because they're yielding more than the 10-year. So prices are lower, right? When it's negative, it means that the yield is actually lower than the 10-year. And it just shows sort of how expensive then those equities get. Now, we haven't been this negative since back in 2002. So if equities are this expensive, Romaine, again, I feel like I was harping on the same point over and over, but does the high yield savings money, right? Does the money market fund money, does that actually need to go anywhere? And does it need to actually go into equities when you can already get something like 5% and sticky on that money market fund?
And of course, the answer to that question really depends on what your outlook for rates is. So let's get that from Gene Tannuzzo, Global Head of Fixed Income over at Columbia Threadneedle Investments, kicking us off to the close here on this Tuesday afternoon. And of course, this is the parlor game right now, Gene. Yields continue to creep higher. Are we talking about the potential for the 10-year to continue to go to that 5% level and beyond? Or is this just kind of the churn that we're going to get as yields stay range bound for most of the year?
Yeah, thanks, Romaine. I think Alex brought up a good point. She said, if stocks are this expensive, the flip side of that is if bonds are this cheap, right? And we can look now with the 10-year yield above 4.6%. And we've seen that level 3 times. This is the third time in the last 2 years. But this is the first time with inflation in terms of the last 12 months of CPI being this low. So that gap, that real yield is the highest that we've seen. And I think, that is attractive. But I really do wonder if inflation, as you implied from the ISM survey, is really what's driving yields higher right now, or if it's really fiscal concerns, as we've had to digest almost $40 billion of new 10-year notes and coming soon tomorrow, another 20 plus billion of 30-year treasuries. So I think fiscal concerns perhaps are driving just as much as inflation right now.
Yeah, and we saw the auction a little bit earlier today, which I think speaks to your point, Gene. And I guess then I'll just throw that question back to you. Should investors be a lot more focused on some of the fiscal policies coming out of Washington over the next few months, or should they pay much more attention to the Fed and inflation?
I think they should pay attention to both, but I think fiscal is going to play a larger role. And I think we have to take that seriously because what we've had so far, if we look back over the last 6 months, is a campaign trail with a lot of comments and interesting potential policies, but that needs to turn into action over the next 3 to 6 months. And that's where bond investors will determine how much supply ultimately we have to digest. I think if you step back, valuation is attractive, but it's attractive because we're dealing with both fiscal uncertainty and uncertainty around the economy. If we look at the labor market, that's really the reason the Fed started cutting. If you go back to that Jackson Hole speech from Chair Powell in August, it wasn't inflation. It was because the labor market had evidence of cooling and they didn't want that to go too far. Now, I think if you look back from August to today, we could say that the Fed perhaps has removed some of that tail risk that they saw on the horizon. As we look forward, I do think the labor market remains important, but fiscal is playing perhaps an equal role now in that equation.
Yeah, Jimmy heard from Adriana Kugler right over the weekend that it's watchful waiting, which kind of speaks to your point. So what do you do? Where do you go on the curve?
Well, I think you do want to own duration in this environment, partly as a hedge to the elevated risk asset valuations that you referenced earlier. But also, we have to think about correlations here, right? We own stocks and bonds in a portfolio at the same time because they don't always move in the same direction. That broke down in 2022 when we were coming from such low yield levels and had an inflation problem. But we don't have that inflation problem now. Back in 2022, all but 2 of the G10 economies had inflation above 7%. Now, all of them have inflation below 3%. The inflation equation has changed, even if it's not perfect. So I think you should feel more comfortable, again, moving out of cash and moving into intermediate treasuries. We like the 5-year part of the curve the best. We think it's more insulated from the more fiscal volatility in the 30-year part of the curve.
The other part, though, of, say, the data that we got today was, I wonder how much of it is in response to potential tariffs, in particular the services, right? Like, yes, services reading was really high. Prices paid, though, also really high. 14 out of the 18 industries are really worried about tariffs. And I mention this because I wonder if we're in for a shock, though, in the first 6 to 8 months of the new administration. And how do you kind of manage that?
Well, I look at it through 2 lenses, Alex. First, I would say, how does it impact corporate margins? Because they can absorb some of that tariff hit, and margins are starting from a pretty elevated place. And then the second is at the consumer level, as we think about consumer price inflation. And we can look back to Trump 1.0 in the first 4 years of that administration. We did have significant back and forth on tariffs. We did have tariffs implemented in many areas, and the average CPI was 1.9% over that time frame. And I think we need to put that in perspective here that, again, the inflation dynamic is very different than what we were talking about a couple of years ago, which wasn't driven by tariffs. And it's not clear that tariffs are universally inflationary, as you might suspect.
There's also the issue, too, that we've been through this before. We already have some of these in place, so maybe the market reaction won't be as severe. It's sort of like, you get that sort of shock of something new coming down the pike as opposed to something that at least we're familiar with at this point as investors, Gene. And that raises the question, is really should investors actually really be doing anything? Meaning, should they be reallocating anything around the prospects of what could potentially come out of Washington, or maybe just stay the course with whatever conviction they had coming into this year?
Well, I would step back and say, where were you 4 months ago? And over the last 4 months, the spread between the Fed funds rate, or essentially what you can earn on cash, relative to a 10-year Treasury, that relationship has changed by 200 basis points, right? So the Fed funds rate is down by 1% and 10-year Treasuries are up by 1%. So the benefit and the incentive to move out on a yield curve and lock in more attractive yields is really there. And I think investors should consider that from a rebalancing and a reallocation perspective into high quality bonds.
Gene, always a pleasure. Gene Tannuzzo, Global Head of Fixed Income with Columbia Threadneedle Investments, kicking us off to the close here on this Tuesday afternoon with the conversation coming up about Lululemon turning, lemons into lemonade. A new analyst called out today claiming the activewear company's America's business has bottomed. We discuss what's next
for that pun.
For the recovery.
That was great. All right, plus a temperature check on the real estate credit market with Bryan McDonnell, chair of global debt and agricultural PGIM Real Estate, why he sees growth of private credit that won't end anytime soon.
I'm a little loopy with all the
cold meds that are in there. Yeah, no, fair enough.
It's going to be an interesting day. Conversation as well about the super cycle in technology and how it's spurring disruption. We're going to talk to a seasoned entrepreneur, Jon McNeill. He's a co-founder of DVX Ventures, former president of Tesla. You want to hear what he has to say. All that and more coming up in a bit, right here on The Close. This is Bloomberg.
AI is going to reinvigorate the video game industry. On the one hand, for developers, it's going to reduce the cost of creating the content. On the other hand, all of the characters that are in the games are going to be smart characters in the future. So every time you interact with them, they're going to be interacting with you in a much more intelligent way.
That was NVIDIA CEO Jensen Huang sitting down with Bloomberg's Ed Ludlow on how AI is going to impact the future of gaming. And this comes after Huang's keynote address in the opening night of CES, where he was kind of like a rock star. Joining us now for more is Ed Ludlow from the Las Vegas Convention Center. Ed, great to see you. That's quite a jacket that he had on last night. I'm really struck by the stock reaction today, down by about 6%. What do people there make of that?
Well, I'm told the jacket is Tom Ford, and it was picked out for Jensen Huang by his wife. The market's interesting. When you woke up this morning, there's the economic data, but there is probably a debate to be had about whether Wall Street kind of understood what it was that NVIDIA was presenting last night. We've become so accustomed to a very simple story. NVIDIA makes the high-performance GPUs that go in data centers, and those GPUs are used to train AI models. What we got last night were new graphics cards and chips that aren't for the hyperscalers, but they are for consumers and developers. Exactly the same chip, Blackwell, but it goes into a desktop or a laptop. And the argument that Jensen Huang's trying to make is that all of the things those unlock, everyday people using AI, just drives more business for the data center business. And he seemed to have a high degree of conviction in that, even if the market is not supportive of it in this moment.
So, Ed, I guess then going forward, what does NVIDIA sort of then have to prove or clarify maybe for investors when we know Microsoft, $80 billion in data centers this year? We had a press conference and President Trump in Mar-a-Lago talking about the same thing, $20 billion investment.
Well, I think I'm right in saying NVIDIA has its next quarterly earnings late February, right? February 26th, something like that. And we did ask him about growth, long-term, medium-term this year, and he was very bullish about growth. There will be a continued AI investment cycle. The first innings of this, and it wasn't that long ago, 2022, when most of NVIDIA's revenue was gaming, suddenly $100 billion is derived from data center. And the argument he's trying to make is that all of this other stuff is simply accretive for that data center business. Even if there's skepticism that that's the case, the key customers and partners, Microsoft, you flagged $80 billion investment, seem to be the sort of crystal ball that evidences that what Jensen is saying, that they'll continue to invest. To my sort of question to him on sustainability, I think his point is that there are just more things you can do with AI now that will need more training to support it.
Well, I am curious, though, Ed, on that point, particularly with the outsized growth in the data centers business and how effectively that overlaps with the other smaller businesses. I thought it was interesting, the focus that he had last night on gaming itself, kind of, I guess, throwing a bone to some of those folks. And I am curious as to how that fits into the broader plan. Gaming was, to a large extent, what sort of made NVIDIA, and he clearly seemed like he's not willing to leave that behind just yet.
Yeah, so the new graphics card is called RTX Blackwell. It literally has the Blackwell chip in it that goes into data centers, just in a smaller form factor. And what they hope will happen is developers in the video games industry will take those smaller form factors, or just gaming nerds, right? There are loads of people around the world. We might not be them. Spoiler, I am one of them.
Yeah, you totally
right, but they spend thousands of dollars every year building custom rigs. There's a big market for that. Yeah. And then at the more macro level, it's simply, you can do much more, much quicker, for much less money, just through quicker rendering. Make more characters, make more beautiful images, and there's a business for that as well. So that, it will take time for that business to grow, but all he told me is it will see growth, and very quickly.
All right, Ed, great stuff. A great interview a little bit earlier today with the CEO of NVIDIA, Jensen Huang. And Alex, one thing that Ed talked to him about was about the new Trump administration coming in. Jensen Huang said he hasn't had a chance to meet with the president-elect, but he would be more than happy to. And we've seen other big tech companies kind of make this pivot now that we're going to get new power in Washington. You got to cozy up to the people in charge. And interesting story on Meta has made a lot of changes, including changing its board, getting rid of Nick Clegg in favor of basically a Republican spokesperson, more or less, a lobbyist. And now we're learning that they're getting rid of all that fact checking that they were allegedly doing already.
Third-party fact-checking. That is out, saying it went too far, which I find really interesting because, as you point out, it's not just tech companies, though. I feel like the pendulum swung from the left and now to the middle or the right, depending on where you look at it. Meta is one example. Look at McDonald's saying it's not going to do DEI stuff anymore. They're going to call it something different. You also have the big banks leaving the climate alliance, which is sort of the next check into the moving away from the wokeness.
Yeah, and it's not, I don't know what that means, but we get to this idea that every administration, every change in administration, everyone sort of obviously wants to curry favor with the new administration and try to pivot to where they think the puck is going to go. But this is kind of on an outsized level. I don't think we've seen, at least in our lifetimes, this much of a transition in policies that we're going to see over the next few months.
Especially because the last administration, it was not an ally. Like, tech was not an ally of President Trump. It was an adversary, and that has clearly changed within the last 4 years. Yeah,
it's going to be fun times here in 2025. Not necessarily fun times for Lululemon today. The shares had risen about 5% here, giving back a lot of those gains here. But one analyst staying bullish on the stock. We're going to discuss why coming up in our top calls segment. That's coming up next here on The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we're going to start this one off with Apple. It's a big one. MoffettNathanson turning sour on the tech giant, downgrading it to sell. The price target down to 188 from 202. Analyst Craig Moffett, well, he says the iPhone maker's high valuation, antitrust overhang, and weakening position in China are taking a bite. In addition, the incoming Trump administration raising a genuine risk that Apple will be targeted with retaliatory tariffs. The share is down 1% on the day. Next up, Disney, the Mouse House, getting an upgrade from Redburn to a buy. The price target of $100, well, that's being bumped up to a street high $147. The analyst says, quote, this is an important moment signaling the end of a structural headwind that had curtailed share price appreciation. And he says Disney's streaming and content performance will be the big tailwind. Those shares up fractionally on the day. And finally, Dine Brands. Barclays cutting to equal weight its recommendation for the owner of the Applebee's and IHOP restaurant chains. The price target lowered to $32 from $43. The analyst saying the restaurant operator is at risk of another negative year amid declining market share and, quote, no visible catalyst path coming into 2025. Shares down 6% on the day, and those are some of our top calls. Let's pivot now to another interesting call out there on the street involving Lululemon. Bernstein upgrading their rating to outperform and upping their price target to $460 from $360. The analysts sweet on the outlook, expecting higher income consumer to help the company and a better spring assortment of goods that will fuel growth in America. The shares, which have been up as much as 5% on the day, just dipping into the red slightly here, down about 0.2%. Pleased to say that the analyst behind that call, Aneesha Sherman, joins us right now, senior analyst of apparel and specialty retail over at Bernstein. All right, let's get right to it, Aneesha. We talk about a stock that was awful last year, down 25%, the second worst year for Lululemon ever. What gives you the confidence here that whatever plagued them last year is behind them in 2025?
Yeah, thanks for having me on. Last year was a combination of different factors. It was the higher income consumer being bearish into the year. That is already changing. We're seeing higher income consumers in our most recent survey work from Q4 24 being more bullish into the new year. They're lapping now the headwind of student loans that they had a year ago. They're seeing rates starting to come down. They're seeing the wealth effect from the market. So they're more bullish into 25. And then on top of that, Lululemon has had, as you said, one of its worst years. It went from 32% U.S. growth in the end of 2022 to 0% in the last reported quarter. And It's been decelerating for 6 straight quarters. And we think that it's bottomed and is now lapping some of that weakness.
So you get the bounce off the bottom. You get maybe some easier comparables on the earnings side this year as well. Talk to me a little bit more about that higher income consumer, Aneesha, because a big narrative in 2024 was how the higher income consumer was trading down to lower cost products. Is that now being reversed?
Yeah, the higher income consumer was extremely bullish in 22-23. They were in revenge spending mode coming out of the pandemic. And then in 24, they were a little bit saturated. They had too much stuff already. They saw student loans coming back. They saw their pandemic savings depleted, credit card debt rising, and were bearish into the year. And so we saw this trade down across the sector from slightly higher end names into more value names. We saw it in department stores, brands, luxury, everywhere. And we're now lapping that weakness, and the consumer is more constructive into the new year.
Aneesha, I'm curious as to understand how their exposure will be to tariffs, for example. So how do you model something like that?
Yeah, so Lululemon does have some China production. It's really China we're talking about here, where the other countries that were named in tariffs, Canada, Mexico, don't really have a production base. So it's a China production issue, but they have enough sales worldwide, including in China itself, that their China production entering the U.S. could be as negligible as zero.
Okay.
Vietnam is their main market of production, so it's not a single risk for China. I don't think it's going to be a big issue, and they can pivot the supply chain within a few months.
So they were already kind of diversified to begin with. How are they on inventory? How's their inventory management?
Much stronger now. They had a big inventory issue in 22-23 where they ordered ahead of the port backlog and then had to clear a lot of that. They're in a much better place now. Their sales were softening, so they had some inventory challenges in North America. They've got a lot of newness coming in the spring, a lot of fresh inventory. That's another reason why we should start to see the demand picking up and the inventory position better aligned with sales.
Yeah, Aneesha, and I'm curious, too, about the competitors. I mean, I know we brought you on to talk specifically about Lululemon, but your note kind of pointed out that you're actually the most constructive on this broader space than you've been in quite a while. And that includes names like Nike, which also was pretty beaten down last year.
Yes, and there's some timing differences, right? I don't think Nike's going to work straight away. I think they need to see the new product working. They need to clear inventory, more of a back half story. But I am constructive on sportswear in general. What we continue to see is that the move towards sportswear was not a pull forward. It is a secular behavioral shift. People are exercising more. They're wearing more sportswear as casual occasions, different use cases, and they're spending more per pair of sneakers as well as owning more pairs of sneakers. So it's just growing. The wallet is growing. The share of closet is growing. And that's happening across markets, U.S., Europe, China. So it is a secular global trend that is going to help all of these names work in the coming several years.
All right, Aneesha, thanks a lot. Really appreciate it. Aneesha Sherman, Senior Analyst of Apparel and Specialty Retail at Bernstein. Should point out with Lulu also, they had a pretty high short interest, which obviously has come down now as the rally has happened. So
yeah, absolutely.
Don't misunderstand that.
Yeah.
You're a Nike guy.
Yeah, pretty much. I mean, that's more just out of habit.
Okay.
I've been a Nike guy, and why change?
Why change? I still want those sneakers with the heel. Remember we talked about this?
I'm not a fan of those, Alex.
I know, but I still want them.
Yeah, you're gonna wear those
with my corduroy jacket?
wear those with those socks that you had on a little bit earlier?
It was real cold. All right, coming up, Bryan McDonnell, Chair of Global Debt and Agriculture at PGIM Real Estate.
Just about 3:30 here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. Yes, we're half an hour from the equity close, but it's the bond market, I feel, that is seeing a lot of the action today in those higher yields in the long end.
Is this the year where the tail really is going to wag the dog, with the bond market really kind of dictating what we see in the equity market? Because all we see and have talked about for the last couple of weeks is kind of the direction of yields and how that correlates with what we're seeing in the equity space, and yields that are going in a much different direction than I think what a lot of people had bet on just a few months ago.
And really quickly, also, Ira Jersey of Bloomberg Intelligence is looking at a 4.7 on the 10-year or 4.74 as sort of a technical level that we could see a lot more higher yields after that if we break through that level, and that could be pretty brutal. And then you could be on the way to 5, 5.25. Yeah. That was not on anyone's bingo card.
And what does it tell you, though, that most of the selling is on the longer end of the curve rather than the shorter end?
Not a Fed play at the end of the day. So what does that mean for different asset classes like real estate and credit? Bryan McDonnell is Chair of Global Debt and Agriculture at PGIM Real Estate. He's the guy to talk to. He blends both. Okay, so you do real estate credit. If we look at a 5% 10-year, how do you feel the next morning?
That's where I get uncomfortable.
Okay.
Right, where we started saying in the real estate market, we think it's priced in the 4s. And we had said about a little bit 18 months ago, you saw it flirt with 5. I don't think it actually closed, but I think it hit 4.99, and you started seeing some stress because that's where we get into a different world.
Where is your world now versus like a year ago? And what do you, like, if we stay in the 4s, what does your world look like this year?
I think the world looks like this year, if we stay in the 4s, a very busy 2025. We haven't been in a credit cycle, we've been in a confidence cycle for this last go around. And it's been much more about borrowers being willing to tolerate the rate than whether they could transact or not. And so as we see that the race to a 3% treasury doesn't seem to be happening anytime soon, you're seeing more of a realization that a 4% 10-year treasury, keep in mind, we started 2024 a year ago at 4%. And people thought that was too high. I think people would take that deal right now. And so I think as it stays in there, we're seeing people just saying, I got to move. And there's a big refinance year coming off of 2015.
When you're looking for investment opportunities, though, given that rate backdrop that you just talked about, I mean, what is most attractive now? Like, sort of what is going to be more resilient? Maybe that's a better way of putting it.
We always think real estate is a long-term asset class. And so we're playing into where we think demographic trends. So we've long overweighted global living, industrial, the offshoots there, self-storage and data centers and various other things. That's been our overweight. Retail's having its heyday. I mean, retail's actually come around. COVID, in a way, in terms of fixed last of the problems. So there's a lot of places. I mean, I would say everywhere but office, we're seeing opportunity.
It's interesting, too, we're having this conversation with you who runs PGIM Real Estate and not, say, a traditional banker at one of the big money center banks. And this is kind of the evolution of this investment environment for real estate. I mean, you guys are the dominant players now in the private space. And I am curious if that aids or distorts the price activity and price discovery in the real estate market.
I think it aids. And I think the diversity of lending is one of the strengths of the U.S. market. I've been in this market for 25 years, so now I'm finally in the center, and people want to talk to me. But so eventually, you wait long enough, you come into the center. But what I mean by that is, as you have a market that's more diverse and of different sorts of lenders, that's good. We need the banks, we need CMBS. Private credit has its really important move, and we see actually, if you go globally, that playing out more in Europe and Asia, which are much more bank-centered, and the markets have less flexibility and less creativity because of that.
Here's my question, though. If we get less capital requirements and a less stringent stress test from the Fed, do you think the banks come back more in full and compete with what you guys are doing?
Absolutely. But we've been here for 25 years. So this isn't, I think some of the narrative that the private credit is covering the bank gap is a little bit of a misstatement. We've been here for a long time. We're going to continue to be here. We partner with banks. They lend to us. We may go behind them in deals. And it's an ecosystem, I think, about much more. And so, we're big partners with the banks, and we'll all find our space.
Oh, that's a good point, that maybe it's not substitution. So you mentioned a ton of different assets that are interesting in real estate. Where's the one you're playing in the most right now, or that you're most excited about for this year?
Still living. Still residential. I mean, we have a structural undersupply of housing for the last 15 years, and that is something that you can't go anywhere without seeing that in the market. We're trying to play into that, trying to figure out how do we add housing to the markets and how do we play to add capital to support.
Well, how do we do that? I don't want to get too deep into politics, but we do have a president coming in to office in about a week and a half's time who's kind of made it clear, at least some of his policy proposals on the campaign trail seem like they were going to try to address some of the housing supply issues in this country. Is that a bankable idea right now, or an investable idea, or do you just kind of have to wait to see the whites of his eyes of that program?
I think we have to see how that plays out. Yeah. But I do think going back to real estate is a long-term asset class. We don't pivot to an administration. We go much more in the long term. We've been doing this for 140 years for us. Clearly, I haven't been that long, 25 years for me. We have to play in the long game. And I think the clear demographic trends are we need more housing, we need more logistics. We're trying to play into that.
When you see the folks who are investing in this space, allocating more to their portfolio in this space, are we primarily talking about domestic investors, or are you seeing more interest from folks outside our country looking to invest in our real estate?
Certainly, we're seeing global investors come into the U.S. The U.S. market is an outperformer. It's got its challenges, but it's still doing really quite well. So we're seeing lots of interest in the U.S. economic story right now, and that is, from around the world.
So for residential, here's my confusion. If you build a super high-end fancy thing where you have a gym, you have a pool, and the whole shebang, that's going to be easy, right, for a borrower. It's going to be easy for you guys to come together. But if you're going to build middle-income housing where you're not going to be able to charge that much, That's got to be a really tough proposition. Like, how is it coming to a deal like that?
Well, that's where the agencies come in. So we're one of the larger agency lenders for Fannie, Freddie, and FHA, and that's their charter. They're very focused on mission, naturally affordable housing, and they're playing into that, in a big way. And so there's capital up and down the capital stack to be able to play into that.
Fannie, Freddie.
Yeah.
Remember we used to talk about them. Are they actually going to come out completely? It doesn't matter to you?
It doesn't matter to us. I mean, I go back to if you spend time trying to figure out how each player, back to the bank question, it's an ecosystem. Everyone will kind of have their space and will kind of continue to evolve. Yeah. But there's capital that's needed for housing.
In terms of residential, where do you think we're going to see the biggest movement this year? Regional, type on residential? What do you think?
In some ways, some of the CBD markets are coming back. There was such a move to the Sun Belts. Everyone's played there. There's probably a little bit of an adjustment in the Sun Belt as some of the temporary oversupply that'll play out over the next few years. I'm not worried. That'll play out, but some of the CBD markets have some good demographic trends.
If we do start to see a material increase in building, meaning building new housing, do you think most of that is going to be multifamily, or are we going to kind of stick with what we've been doing for decades now, which is primarily a focus on single-family homes?
Yeah, I would say I'm focused on multifamily, so I don't know the single-family market terribly well. We focus on a multifamily.
That's a Mariah Carey answer. I don't know her.
Well, but what I would say is the reason it's there is that the reason it's an interesting asset class is the last cycle was an appreciation and leverage game. As rates went down, you were able to appreciate and leverage your way. This next cycle, we're already in it, is all about income. And the stable income that provides, which is what credit shines, right? That's a good opportunity for credit, but also plays for certain asset classes that we like in industrial and residential, because those tend to be income plays. They're not necessarily an appreciation play.
All right, great conversation, Bryan. Always smart. Bryan McDonnell, is chair of global debt and agriculture over at PGIM Real Estate. A closer look here at the real estate outlook for 2025 as we focus in here on the here and now, with the market now hitting session lows as we continue to count you down to those closing bells just about 22 minutes away. When we come back a little bit later, we are going to focus a little bit more on M&A, because some of the stocks that are rising today are because of a little bit of a merger blitz that we've seen to start the year. That's coming up next in our Stock of the Hour. Stick with us. This is The Close on Bloomberg. It's been a busy day for M&A. Getty Images up today after confirming some of the news out there that it would acquire rival stock photo provider Shutterstock in a $3.7 billion deal. And then also on the M&A front, Paycheck agreeing to acquire rival Paycor for about $4.1 billion. That's Paycheck's largest ever deal, at least when it is finally completed in the first half of this year. Isabel Lee joining us right now to talk a little bit more about what's going on here. We had Getty and Shutterstock up there right now, so let's talk about that deal first here. This has been long rumored, now confirmed by the companies here. Where are we going with this?
So this deal brings together two of the biggest licensing content visual in the U.S. and it comes as artificial intelligence really plays a role in content creation and upending that. And also as we all have better mobile phones and we take photos. Everyone now is a photographer. So it comes as those two together. And both stock are jumping today. Getty Images sank around 73% since it went public in 2022. And even Shutterstock also fell around 50%. So both aren't doing as well. But today, you see them both skyrocket. Getty now is up 20%, as much as 50% earlier in the day. So this will also serve as a litmus test to how the Biden-Trump administration will handle this. Because as we know, they're fairly concentrated industries. Some are saying if this happened during the Biden industry, well, it still is. It probably would have been blocked.
Well, it's kind of interesting, too. I could kind of see how Shutterstock and this company would actually be okay, meaning might get through antitrust regulators and Getty. Thank you. But we go to the other one, Paycheck and Paycor, which are very similar companies. I mean, there is no light between these companies. And I do wonder if this deal would have been announced had Biden been reelected as president.
That's exactly right. They're both payroll processor companies, and they're going to be Paychex is acquiring Paycor for $4.9 billion in cash. And that's really the big question. And our Bloomberg's deals team has been really busy. They called Monday Merger Monday, and now it's Takeover Tuesday. I can't think of anything better for Wednesday. But I think a lot of the Wall Street banks are really optimistic with this administration. We have big law firms looking at tech, energy, banking as possible areas of growth. And we have a lot of really these banks just excited. Even IPOs are ramping
How
up.
about Wedding Wednesday?
I was saying widespread Wednesday. Widespread Wednesday.
Wackadoodle Wednesday?
Widespread merger
we could do this all day
Wednesday.
as
Yeah,
well.
no, we really
Just don't
could
go anywhere.
actually.
We'll be back.
But I'm so interested that you made all these points because I was looking at the MA Go, so you could look at the league table and see what was happening. And since the election, there have been $311.2 billion worth of deals. It's up 12% on a year-on-year basis, and that's like pending and proposed, and a lot of them in tech and materials, which you would not have expected, particularly when it comes to tech.
Even energy. And the Trump administration is really primed to usher in a new business-friendly era. And even in private equity, where buyout firms are sitting on trillions of dollars of unspent capital, the environment is expected to improve. And this is tangential, but even IPOs, at least 9 companies are targeting IPOs in 2025. So I think everyone is just going to get a really good payday in 2025, or at least most people.
I got that one. But I also go back to Getty for a second, because what I found interesting about Getty is I wonder how much of a defensive AI play that was. Because if you can wind up using AI to generate images, right? And obviously Getty has stock images that, are huge, like the Hindenburg, for example. Like they have those images. But if you're going to have like random people at malls, like do you need to go to Getty or can you do AI?
That's fair. I mean, Getty is known for its immense library of photos and videos. Shutterstock is kind of like this huge platform where people can upload content. I actually remember looking at Getty when I was younger. And then, I mean, now even celebrities, they upload photos on Instagram with the Getty watermark because it's still kind of a premium if a real Getty photographer takes your photo rather than the mobile phone, but still.
Yeah. Oh, so is that how I know I made it when Getty finally takes my photo?
There you go. Yeah. But you can do your own watermark and just like brand yourself.
Just put
pretty much.
on there.
Yeah, you're just like at Getty.
But I don't have a team of lawyers behind me to enforce the trademark and copyright.
Isabel, thanks a lot. Appreciate it. Bloomberg's Isabel Lee joining us. Should point out, guys, we are deteriorating as we go into the close here, Romaine. You're looking at a NASDAQ off by a full 2 percentage points. Same for the NASDAQ 100, the S&P down 1.3%.
Yeah, and we talk about sort of what's ailing the market and the idea that some of the biggest winners now being sold off.
Yep, we'll break all that down for you. 15 minutes to go to the closing bell. This is Bloomberg.
You should feel more comfortable, again, moving out of cash and moving into intermediate treasuries. We like the 5-year part of the curve the best. We think it's more insulated from the more fiscal volatility in the 30-year part of the curve.
Gene Tannuzzo over at Columbia Threadneedle kicking us off to the close just about 50 minutes ago. I'm not sure what the biggest story is right now of today, whether it is the moves that we're seeing in yields or this drop that we're seeing in stocks.
They're related because you got to take a look at what happens when we got the JOLT data and the ISM services data at 10. That's when the market started to reverse and we just grinding lower. Now we're right around the lows of the session. Tech definitely can't get a bid. Nvidia, the worst performer in the Mag 7, off by 6%. Apple also getting a downgrade. I mean, it was just pretty brutal. And the Russell down by a full 1 percentage point, Romaine. All right, let's welcome here Amanda Agati, Chief Investment Officer with PNC Asset Management Group. Amanda, what is the main story of today? How are you looking at it?
All that much on what's happening today, which I know may be an insane thing to say, but we're really sort of zooming out and kind of thinking more broadly about how to reset the deck for 2025. It's going to be a very different year, and I think that's coming home to roost here very quickly in the first few trading days of the year. There's a lot of policy-related uncertainty out there. Yes, some of the economic data is coming in a bit mixed, but it's actually still a very solid backdrop. And so I think the key question for investors is, what do you do in an environment where things still seem pretty solid, but the policy is the real wild card, and it has the potential to be material positive and or material negative. We just don't know enough yet.
Right. And
I think that's the dilemma.
And in the meantime, though, you still have yields creeping higher, right? The 30-year, very close to that 5% level, about 25 basis points, maybe a little bit more when it comes to the 10-year at that 5%. I mean, when do yields damage equities, and how do they do that?
Yeah, I'm not sure that I can give you a great answer in terms of when they start to damage equities. I mean, I think what we're seeing now is very much a reflection of the bond market worried about deficits and debt levels. For years and years, the market seemingly shrugged off what was going on with deficits and debt levels. And so what we've seen in the last few months, this almost inverse correlation between what's happening with the policy rate and what the Fed is doing and what we're seeing in real market-based rates is a reflection of maybe we're hitting a key governor here, a key limit in terms of how far we can push it. And so I think it's much more about what policy ultimately may come and change the game or not for the trajectory of deficits and debt levels than anything else. That's what we think is going on in the fixed income market right now.
I am curious, though, and when we overlay that kind of with the correlations in the equity space, I mean, where does money go right now, Amanda? Because there are a lot of people that will look at stocks, they look at the high valuations, and they look at this increase in yields, and it's kind of pushing back on that. You look at all the money in money market funds, you look at all the investments in short-term treasuries. Where's that money going to go?
Yeah, it's a great question. I think it's a really important theme for 2025 is to rethink cash allocations or capital allocations. And so we've had a lot of clients that have been sitting on and stockpiling cash, missing out, a little bit of FOMO, missing out in terms of this really strong market rally we had over the course of 2024. And so with yields starting to come down, with money market yields starting to fall as a function of what the Fed is doing, we're really encouraging investors to put that cash to work. And I think the sweet spot is really the belly of the curve. We don't want to go too far out in terms of extending duration, certainly not with the concerns around deficits and debt levels, but that sweet spot in the 5 to 7 year area looks really attractive. There are also pockets of equities that look attractive too. It doesn't have to be a fixed income story.
So when someone calls you and they say, okay, you know, should I allocate a little bit more to fixed income space? Should I allocate more to equities, or should I allocate more to something like hard assets and, private capital? Is there sort of an area you steer them to?
Can I say D, all of the above?
I knew you were going to do that.
I mean, that's such a cop-out answer, but as a multi-asset capital allocator, we do find opportunities in public equities and fixed income and in alternatives. I mean, alternatives in particular had a tough slog last year. I think the stage is set for a return to deal making, M&A related activity if the regulatory backdrop loosens up a bit. And so I think this could be a particularly interesting time for allocations to alternatives and vintage year 2025 funds. We're still very focused on quality exposures in public equities, hasn't participated to the same degree as some parts of the market have rallied. So if you pick your spots carefully and you take a more actively managed approach, rather than just, looking for passive beta exposure, I think you're going to be pretty well positioned for this new year.
What do you do with the AI theme, Amanda?
Well, our view on this is that the story historically has just been literally one stock, right? NVIDIA has been the only game in town as it relates to investors' mindset around playing it. I think in the second half of 2025, we're going to start to see some broadening in terms of adoption and use cases. And so I think the story becomes much more appealing outside of just NVIDIA. I'm not necessarily betting against NVIDIA, but I think the healthier aspect of this is to see more broadening in terms of use cases and adoption across the market. And if we get that, and our expectation is that we will start to get that, I think that could be a much needed boost to operating margins in the second half of the year.
All right, Amanda, going to leave it there. Amanda Agati, she's the Chief Investment Officer with PNC Asset Management Group. An interesting look here at maybe how you allocate in 2025 with a lot of headwinds out there. We are going to continue to focus here on the financial markets as we march to the close, but we need to take a time just to acknowledge here the funeral procession for former President Jimmy Carter being led, I believe that is down Constitution Avenue in Washington, D.C., on a horse-drawn carriage's casket draped in the American flag.
The procession is led by military formation mirroring the one that escorted the Carter family on foot from the Capitol to the White House on Inauguration Day, January 20th, 1977. It will include the U.S. Army Band, Pershing's own. That's a marching element from each of the armed services in existence during the Carter administration. Also looking at music like God Bless America, Flowers of the Forest, and Our Fallen Heroes.
Yeah, and of course, the official state funeral will be tomorrow. Thursday in Washington. Thank you. Thursday in Washington at the National Cathedral, which is just a couple of miles north of Capitol Hill. The 39th President of the United States being laid to rest. All right, we are going to pivot back to financial markets now as we continue to count you down to the closing bells. Just about 3 minutes to go here in New York, here on Wall Street, with stocks off the lows of the day, Alex, but still not a good day. 2% drop right now on the NASDAQ indices, 1% on the S&P.
Yep, off the lows, but, it's still been a pretty brutal day across the board. I'm really struck, though, by NVIDIA. And granted, we did close at a record yesterday, so there is a little bit of give back. It's the first record we've seen since November. But that slide, almost 6%, is pretty dramatic, really leading all Mag 7 stocks lower also.
And this is kind of the problem I think a lot of these AI stocks have. There was a lot of hope built into these prices over the last year. Need to see the profitability, need to see the revenue growth. As we break down all of today's market action, you don't want to go anywhere. A global simulcast starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Alex Seal. We're taking you to that closing bell with the global simulcast, and it starts right now. Scarlett Fu in the TV studio, Carol and Tim in the radio booth as we welcome our audiences across all of our Bloomberg platforms to parse the most crucial moments of the day. And Carol, I think I've said this a few times over the last few weeks. A big turnaround from what we saw yesterday.
Unbelievable. I mean, the equity trade, and I'm also kind of obsessed, and I can't tell if you're getting a little bit of a cold and worn out by what we continue to see in the volatility in the Treasury traded narrative, right? We've got yields moving up. We had an auction today, 10-year auction, but we also had some service sector economic data that showed some price pressures. And so once again, we're thinking about higher rates and less Fed action in 2025.
Yeah, so perhaps it's fair to say the crucial moment of the tech day, or the crucial moment of the day today, the trading day, was 10 o'clock when we got those JOLTS numbers and the ISM Services Index, and we saw investors get concerned about inflation not going back down to the Fed's target. And, I guess everyone now looks to Friday for what we get with the jobs report to see if that offers any insight into just what the economy is looking like.
Yeah, right now, good news is being seen as bad news for markets. Let's not forget, too, we got a reminder of the volatility we can expect after January 20th when President Trump held a news conference and talked about absorbing Canada, seizing the Panama Canal and Greenland, and renaming the Gulf of Mexico to the Gulf of America.
I do want to go back, though, to the ISM services, because I understand it looked really good, but digging in between, there were a lot of concerns about tariffs, and the rising prices in that was also a little bit worrisome as well. It doesn't feel like it's all clear on that end.
Yeah, I'm glad you went back there, because I think that really rattled a lot of folks. And I mean, obviously, one report does not sort of make a trend, but again, the trend was supposed to be in the opposite direction. And just a quick reminder, we are expected to get earnings after the bell from Cal-Maine, an egg producer. Remember eggs?
Eggs,
all the talk
expensive
during the election here. Eggs are expensive. My wife was just complaining about that last week. Take a look across the screen here, and it is red across the board. The Dow Jones Industrial Average down about 178 points here on the day, or roughly about 0.4%. And believe it or not, that's actually your outperformer on the day. The S&P down 1.1%, the NASDAQ Composite down 1.9%, the Russell 2000 down 0.7% here on this Tuesday afternoon, Carol.
All right, taking a look, you got it, Romaine. Taking a look at the S&P 500, you had more names to the downside, 295 losing ground on this Tuesday. Scarlett, 206 to the upside.
All right, let's take a look at the IMAP, which shows the breakdown by sectors. A lot of red there on the screen. 11 sectors overall, only 2 finishing in the green. Energy stocks gaining more than 1%. Healthcare also eking out a gain of 0.6%. As for the worst decliners, those are all in the tech space. Infotech itself losing 2.4%. Consumer discretionary, which includes Tesla, down more than 2%, and communication services off by 1%.
All right, guys, to the individual gainers, and really strongly in the green column, Moderna. This is your number one gainer in the S&P 500, up just shy of 12%. This is after the first bird flu death was reported in the United States. Moderna and other vaccine makers in general gaining some ground today. Moderna, by the way, is one of the few drug makers currently developing a vaccine for the HFNY bird flu, which is, as we said, spreading rapidly through farms and wild animals in North America. And again, the first death reported in the United States. Micron Technology, I got to say, the NVIDIA effect, helping out some stocks, if not helping NVIDIA itself today. And Micron is one of them. We're going to talk NVIDIA from Tim in just a moment. But Micron Technology, again, a top gainer in the S&P 500 and NASDAQ 100, up up as much as 7.5% at its highs today, finishing the day up 2.7%. NVIDIA CEO Jensen Huang saying Micron is providing memory chips for its new GPUs, so that gave a boost to that name. And along those lines, Aurora Innovation, at one point it's been a meme stock. There's been lots of questions. This one, though, at its highs today, up 51%, finishing the day with a 29% gain. It's about a $15 billion market cap, maker of self-driving technology, soaring to a record. The self-driving tech company partnering with Continental and NVIDIA to deploy driverless trucks at scale. So that one getting a boost. So now to NVIDIA.
Yeah, NVIDIA is the story today. I mean, shares actually hit an intraday record earlier in the session, but then fell and pulled the markets down with it. 6.2% to the downside today. A wide-ranging product presentation by Jensen Huang failed to propel the AI chipmaker to new heights. Following that, NVIDIA's latest announcement has given an upbeat view of the company's long-range prospects. However, there wasn't as much near-term upside as some investors had sought.
I thought it was interesting, though, Tim. I mean, you look at some of the other presentations that came out of CES and the market reactions there, like Mobileye, of course, taking a huge leg down after its executive presentation. But then a few other companies that I think would benefit from whatever the heck Jensen Huang said, they all rallied on the day.
Yeah, Carol had plenty of gainers today as a result of what we heard from NVIDIA. Look, shares were already higher by more than 10% this year going into today. So, look, the shares have been higher by triple digits over the last 2 years. So this is a company that has gone high very, very quickly. Still 6.2% decline. It's the most going all the way back to September in terms of a single day decline. I do want to talk about shares of Apple. They fell as MoffettNathanson downgraded the company to sell, citing high valuation, antitrust overhang, and a weakening position in China. Shares down more than 1% today. The firm did set a price target of $188, which before today's open implied a 23% decrease. Ooh. Bloomberg tracks more than 50 analysts who cover Apple. Only 4 have sell or underweight ratings. And in just a few minutes, we're going to be speaking to Craig Moffett. He's standing by. He's going to give us more on why the downgrade and also some of his stock picks.
He's standing right next to you right now?
I see him on the screen. Okay. Waiting to come on.
He's stealing viewers there.
Maybe you want to take some cold medicine, Romaine.
He's on it. He's on it. Trust me.
I am.
All right.
You got to get the good stuff behind the counter, Romaine. Everybody knows that.
Yeah, I've
okay, Tesla. Do I have time for Tesla, guys?
Oh, sorry.
Yeah,
yes.
Sorry. I want to check in on shares of Tesla. They fell. B of A cut its rating to neutral.
Let them finish. You can't interrupt these people. Don't do that on the show.
Lower today. Alex can, it's fine. Alex has got to do yields. That's the real story today.
I mean, I was just saying, usually I'm like, it's boring, move on. But today it was actually really...
I'm going to let you go, Alex.
Okay. It was just a really big deal in the bond market. Yields are really moving, particularly on the back end. You had the strong JOLTS number, you had the strong ISM services, but then you got that 10-year auction, and it was bad. It was not good. Bid to cover was weak. You had indirect bidders weak. It was pretty brutal. And then tomorrow you get that 30-year coming in, about $30 billion auction coming in. Now, I was talking to Ira Jersey, Bloomberg Intelligence chief U.S. interest rate strategist. 4.7. That's his thing. 4.7 on the 10-year. We are right there. He says positioning-wise, that could be pretty brutal, and you could see some selling really pick up after that. So watch that level. See? Sorry.
All right, guys, we are getting some earnings out of Cal-Maine, of course, the largest publicly traded egg producer in the United States. Net sales coming in at about $954 million and change. The street was looking for $751, so a big beat on the revenue side and a big beat on EPS, $4.47 a share. The street was looking on average for about $4.05 a share. You have to dig through this release, but it's really no real mystery here why the results are as good as they were. Prices for eggs have been going up, partly because of supply issues, partly because of bird flu. Net sales up 82% year over year.
Yeah, the company is saying that our results also reflect higher market prices, which have continued to rise this fiscal year as supply levels of shell eggs have been restricted due to recent outbreaks of highly pathogenic avian influenza. The company did go on to say that there's been robust demand for eggs, resulting in significant increase in dozens sold for the quarter.
And here's your number: 58% net average selling price for a dozen of eggs. Cal-Maine is reporting year over year, 58%.
Ouch. Well, we all feel it, right, when we go shopping. Hey, you know what, though? You can get kind of cheaply or less expensive. How about some used luxury high-end watches?
Oh, yeah, let's buy them by the dozen. Let's go buy them by the dozen.
Rolex Patek Philippe, what are they? Falling to a 3-year low prices here in 2024. Actually, last year, I should say.
The Bloomberg Subdial Watch Index, yeah, it's a thing. We track watch prices. It tracks prices for the 50 most traded models by transaction value. It declined nearly 6% last year to its lowest price since 2021. Rolex models dropped 5%. Patek Philippe dropped 4%. Audemars Piguet prices lost about 7.5% in the used market.
But you know which watches held their value the best? Cartier, only down 1/3 of 1%.
Oh, yeah?
Yeah.
What about Swatch? Asking for a friend.
No, they had the Swatch has the moon watches. They're super expensive and they're really hard to get. But this is actually a really good wealth indicator because these watches hold their value. So if those prices go down, that actually winds up meaning something.
That and Chanel bags and Birkin bags.
You know
right?
who can use these watches, guys? Folks that have to kind of head back to work down the street from us.
I feel like this is
nice.
JP Morgan is telling everyone to go back to the office 5 days a week. Forget about the hybrid work option. They want everyone in. Previously, managing directors were required to be in 5 days a week, but now we're talking about everyone. And we know Jamie Dimon has been on this, right? He's been pushing for everyone to get back into the office because everyone works better. And, once one bank does this, everyone else kind of, cracks the whip.
I was wondering,
do they work better? Because I've heard this narrative from all these companies saying that everything works better, but then we've gone through this stretch since the pandemic of these companies posting record profits, record jumps in revenue growth.
But they could do even better.
Oh, Scarlett, you would make a great CEO of a big faceless corporation.
I just wonder how long it's
someday.
going to take for JP Morgan, Bank of America, to get the headlines that cross 5 days a week in the office.
All right. Well, this may come up on that earnings call at JP Morgan, right? That's going to happen in a couple of weeks. All right, guys, that's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We will see you again, same time, same place tomorrow for the closing bell.
Here on January 7th, we push ahead here on Bloomberg Television to the outlook for 2025. A sit-down conversation with Tony Roth, the CIO over at Wilmington Trust. That conversation up next, right here on The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Let's get a quick check here on how the markets ended the day. Not well. We came into today with futures pointing to what was going to be a third straight day of gains, but then we got some interesting economic data showing a potential reigniting of inflation. That sent stocks down more than 2% at one point here for some of the major indices. We closed out the day with the S&P down 1%, the NASDAQ Composite Index down about 1.9%, the Mag 7 down more than 2.5%, the NASDAQ Computer Index down more than 2%, and that all ties to what we saw in the yield space. 469 on your 10-year yield, an auction that we had earlier today, the highest yield on a Treasury auction for the benchmark yield going back, Scarlett, to 2007.
And the stock at the center of the declines for the S&P 500 and the NASDAQ was really NVIDIA, retreating from a record high, losing more than 6% on the day. It also saw a wave of call option sales. Now, the CEO, Jensen Huang, did talk about a bunch of new chips, new software, new services at CES in Las Vegas. Those are all long-term investments. He didn't say very much to give the stock a pop in the near term. Moderna, on the other hand, the best performer in the S&P 500, extending its gains to a fifth straight session, closing up almost 12% on the day today. Vaccine makers, as well as pharmacy companies and hospital companies, getting a huge lift here as seasonal flu cases across the country continue to increase. We know Moderna works on a flu vaccine that's combined with the COVID vaccine. It's also doing some work on a bird flu vaccine as well. But bring it all back to the economy. Our top story this hour is really fresh proof that demand across the service industries is resilient, but inflation may also prove to be sticky. Now, according to the latest ISM index, growth at U.S. service providers picked up at a faster pace than expected in December, while the prices paid for those services also climbed to a 2-year high. You add it all up, and traders are now betting that the Federal Reserve will refrain from cutting interest rates again before July. So later in the program, we're going to be examining the extent to which perhaps this does or does not reflect New York City's economy as well.
And of course, that's having to factor into all of the outlooks that Wall Street has been putting out for 2025. Wilmington Trust out with their forecast, and they're actually comparing the U.S. economy to a game of chutes and ladders, writing that the year ahead will bring a new administration with new policies, the particular cocktail of which sets up the economy and markets for a wide range of possible outcomes, potentially higher highs, but also potentially lower lows. Tony Roth joins us right now. He is the CIO at Wilmington Trust. And let's expound on that a little bit, because I think we've already gotten a little bit of a taste of some of the volatility in store for markets based on the comments we've heard from the president-elect since he won the election back on November 5th. Is that going to be the story for 2025?
Well, thanks. Hello, Romaine, and thanks for having me today. I think it's going to be the story for the beginning of the year. The markets are clearly in a very reactive state. They're very volatile. the magnitude of informational content that we have right now is pretty limited relative to where we'll be in just a few months as it relates to whether it be tariffs, whether it be tax policy, the level of deportations that we may see, the speed of deregulation that comes from executive orders, the speed of deal making. So right now, there's so little information available relative to where we'll be that even relatively small amount of information, like the increase in costs in today's ISM services, can have a profound impact on markets, when, to the contrary, in our view, we actually are in a very persistent disinflationary environment, and we think that today's inflation number, if you will, buried in that ISM report is really just an outlier, and we're going to see quite a few Fed rate cuts this year. So again, very sensitive market to relatively small pieces of information right now.
What are the expectations, though, right now, Tony? Because that's obviously going to play a big part in the types of market moves we see. You mentioned the rate cuts, but you now have a market that has kind of priced those out to a certain extent. If the expectation comes back for rate cuts and we don't get them, or we don't get them at the same magnitude, is the market position wrong for that?
Well, I think that a lot of investors are positioned wrong for that. We've seen flows very weak in the equity markets, and I think that there is a base case scenario for a little bit less than 2% growth in markets, and as I've mentioned, very persistent disinflation. And so, as an example, last year, consensus coming into the year was for 6 inflation cuts last year, 6 quarter-point cuts. Then the market pulled back to 1, and then we ended up getting 4. So the market view coming into the year is a very poor indicator of what the Fed ends up doing. And if you look at the underlying data and you examine, for example, the labor market, and you see that the average duration of unemployment, you'd have to go back about 8 years to see such a long average duration of unemployment, because the turnover in the labor market is just so low right now. As productivity increases, as companies don't have as an acute a need to bring on new workers, so on and so forth, what that all suggests is that we are going to see a cooling of prices, as we have seen last year. We did have a little bit of a stickiness at the end of the year due to some of the strikes and some of the weather and the hurricanes and so on and so forth. But when you take a broader step back, and we're long-term investors, what we see is a continued disinflationary environment, more Fed rate cuts coming this year, and that sets us up for a decent year in equities. Not a great year because of valuations, but a decent year.
A decent year. So with the greater volatility in this decent year in 2025, do you anticipate more tweaking of positioning here and there, or wholesale reallocations? Which is more likely, do you think?
Well, again, as long-term investors, we tend to ride through a lot of the volatility in markets. I think that coming into the year, what's really important is to set up the portfolio for the areas of the market that are very likely to benefit from the installation of new policy. So I would start with regulation and deregulation more specifically, where we expect to see energy, industrials, financials outside of insurance companies in particular, even healthcare, even big tech and AI. These are all areas that stand to benefit through deal making as a result of deregulation. So that's an area that you want to make sure that you have a sufficient exposure in your portfolio. And quite frankly, I wouldn't be looking to underweight right now the Mag 7 or the major providers of AI, because we're still in the early innings of what is likely a generational increase in productivity that's all driven by primarily AI. And so it's important to be able to keep that portfolio with a full weight to those big companies that are massively growing their earnings on the back of productivity.
Okay, so stick with the Mag 7 and ride through that as well. Earnings season is just around the corner, Tony, and as always, the outlook will matter more than the numbers for the quarter that ended. Given all the optimism about Donald Trump's pro-business agenda, as well as the known unknowns of his policy, do you think the commentary that executives will offer will veer on more cautious or more upbeat?
Well, I think that it's going to be cautious because he will not have, for many of them, even come into office yet, for the earlier reporters. And then as we get into the quarter, I think that it's going to be very early. I do think that what we're going to see is right now the major shoot that people are worried about is the idea of tariffs, is the idea that tariffs could go from an average of 2% of exports to 19% if we were to see tariffs that manifest the full extent of what the president has talked about, or the soon-to-be president has talked about. That's not going to happen in our view. It's not going to happen at all. It's not going to happen quickly. And I think there's going to be some relief as we start to see the arrival of policies in the regulatory front, later regulation. And I think that as these tariffs take hold, what we're going to see is actually a lot of opportunity as those tariffs shake open other markets around the world to create opportunity for U.S. businesses. So I think in the beginning it's going to be very slow for markets to react and for the C-suite to get comfortable. But over time, I think you're going to see sort of the animal spirits start to come back into corporate America.
All right, good stuff. Tony, appreciate your joining us and giving us your 2025 outlook. Tony Roth is CIO of Wilmington Trust.
We do have some breaking news. This on the gambling company Flutter. Those shares down about 4% in the post-market. This after the company provided an update on its outlook, saying that it expects revenue for 2024 to be down by about $390 million, or $390 million less than what they had previously forecast. And it's kind of interesting, Scarlett. They had given their earnings report back on November 12th. That was Q3. It was a very strong report. They're saying that they actually saw a deterioration in the amount of folks actually betting, particularly when it comes to the NFL parlays and same-game parlay outcomes, saying that they saw a significant deterioration in November and December that will have a meaningful impact of about $390 million on full-year revenue.
Yeah, deterioration for them, but customer-friendly results, as they point out in the news release. So for those who did make those parlay bets, they're probably feeling pretty good.
All right, we'll keep an eye on Flutter Entertainment. Meanwhile, we want to pivot back to the economy, and really the most important economy in the country. There is no metropolitan area with the economic footprint of New York. More than $2 trillion in economic activity each year, of course, anchored by Wall Street and the arts and entertainment industries. But in a first ever State of the Economy report for the city, Andrew Kimball, CEO of the New York City Economic Development Corporation, says the economy is actually diversifying and the rollout of artificial intelligence will be a big part of that push. Pleased to say that Andrew joins us right now here in Studio 2 at Bloomberg headquarters. Great to see you, Andrew.
Great to be here.
I read through this entire report, and there's a lot of familiar stuff in there about Wall Street and the Arts and Entertainment District. But I do want to talk a little bit about AI, because I thought it was interesting the focus that you put on there. Not just AI being a beneficiary, but the idea that it is actually going to be disruptive to a lot of industries. But you think that disruption long-term will be a net positive?
Yeah, well, let me just start by saying, if you think back 4 years ago, a million jobs lost in New York City, folks talking about an urban doom loop, fiscal crisis as bad as the 1970s. What this report that we just put out on the annual State of the Economy shows is that none of that has come to bear. In fact, the fundamentals of New York City's economy couldn't be stronger. More jobs than at any point in our city's history. Highest workforce participation rate, meaning people employed and looking for work, and an incredible diversification of our economy. This has been happening for 30 years in tech, in life sciences, in the green economy. What is happening with AI, though, is extraordinary. It will change everything. This is both a tech subsector in and of itself, and it is a tool that will drive invention around life sciences and the green economy.
Talk a little bit more about that. I was looking at the spending by VC firms that you kind of highlight in the report, and obviously San Francisco, Bay Area sort of is at the top of that list for obvious reasons. New York's number 2. And I know a lot of folks don't think of New York as kind of a tech town, even though it's always, for the most part, been that way for the last 30 years or so. Give me a sense here as to what the share of our economy is going to be related to the tech sector, particularly when it comes to AI. Is that going to create a much larger share of what our GDP is here?
Absolutely. And what differentiates us from San Francisco, look, a lot of great things happening in San Francisco, a lot of the large language models created here, there. What will happen in New York is it gets applied across the diversity of our sectors. Finance, life sciences, green economy.
Gotcha.
That is the difference maker for us, and we are already becoming the applied AI capital of the world. And, they talk about 4 in 10 jobs being augmented by AI. That means improved in terms of efficiency. That means more earnings. That means more revenue for the city. And over time, it will be more people employed.
What is it that the city did to put itself in this position? I'm wondering how much of this is luck versus active planning.
Look, this is a 30-year effort on behalf of the city. EDC is New York City's economic development arm. Every mayor has an important footprint in that. Mayor Adams has put public safety and private sector partnership at the top of his agenda, and that's really created the tools for us to drive partnership with the private sector, big, large projects, but also address our major challenges like housing. We now have a set of tools, thanks to the mayor and the governor, city council, state legislature, that allow us to convert office space to residential, build hundreds of thousands of new units of housing to really address that issue and help New York City grow as more. I'll just say one other tremendous stat that gives us hope.
What's that?
500,000 recent college and university graduates have moved to New York City since 2021. That's on top of the 500,000 college and university students here already who tend to spend, 75% of them, a decade or more in New York. We've got the talent. They want to be in New York because of the diversity of our economy, because of the quality of life.
They want to be in New York, but they're also worried about public safety, and they're also worried about investment in public transportation. We're seeing the congestion pricing kick off this week, and it's still too early to, make too much out of what we have seen so far. But what is your department's recommendation in terms of how to move forward with spending to ensure safe transportation for residents of the city without breaking the bank?
Yeah, I mean, the transit system is the lifeblood of New York City's economy. Getting people to home and to work expeditiously, that's an efficiency issue. That helps drive the economy. So what congestion pricing will hopefully do is create the resources that MTA can bond against to invest in the capital infrastructure to make sure that the subways stay in a high quality state of repair. I grew up in New York City in the 70s and 80s. I remember what it was like. It is tremendously better.
Right.
We can do so much more.
But for those of us who weren't here back then, and we come here, I was on the subway yesterday. I made sure when I was standing on the platform, I had my back to the wall. If you want people to come back to the office, you want tourists to come here and feel free and move around, you have to have a public transit system that's not only efficient, but safe.
100%.
Yeah.
And the perception is real.
Yeah.
There have been some real tragedies recently on the subways.
Right.
What this report is about and what the police department puts out is the facts. And the facts are that we've had 10 straight months of crime overall coming down. We remain the safest big city in the country. We have hit a record high of tourism this year. We have hit our high this year of 64 million, 65 million. We're going to go to 68 million next year. And young people are flocking to New York. So yes, we have to be mindful of that perception issue. Right. We are very confident of the new leadership of the NYPD taking us in the right direction.
But you're also
addressing this.
I mean, every city is in competition to some extent with other cities. I mean, we saw the migration of a lot of folks from Wall Street down south during the pandemic. I know some of that is reversed, but not all of it. I mean, who is your, I guess, direct competitor, if you will, when it comes to growth?
So I want to address the finance issue because that is one of the core industries in New York City and will remain for a long time. And 4 years ago, people were talking about all those jobs going to Dallas and Miami. We've had a net gain of over 25,000 jobs in finance since COVID. So it is growing, and it will continue to grow here. And partly it'll be driven here because of these other innovation sectors like tech and life sciences really exploding, and the green economy as well.
All right, Andrew, a pleasure to have you with us. Thank you so much. Andrew Kimball, CEO of NYC Economic Development Corporation. I think you pointed out an important thing, which is the perception of safety matters most. It's paramount here when it comes to people feeling comfortable in the city.
And perceptions matter. I mean, obviously, we're here in New York, and he talks about being a lifelong New Yorker, and that creates a certain perception, too. But it's funny, I'll talk to people who live in other parts of the country, and when you tell them where you live, they're like, "Ooh, are you okay?" And I'm like, "Yeah, I'm fine."
Especially those outside the country, too.
But that's the perception that somehow we're in some dangerous war zone. It's like, no, I strolled through Central Park last night, and it was great.
Yeah.
I mean, other than the 20-degree weather, but other than that, it was great.
Just fix that, and we'll all be good, right?
Yeah, I don't think he can fix the weather, but it'd be nice if he tried.
That would be the last thing that we need fixed. All right, coming up, we're going to speak to Jon McNeill. He is the co-founder of DVX Ventures, also the former president of Tesla. Get his take on the AI sector, continue that AI conversation. Also the launch of Vista Shares' first ETF. This is Bloomberg.
XAI is working on foundation cognitive intelligence AI. Tesla is working on autonomous vehicles, and Optimus is for humanoid robotics. These three areas of AI are the three most important areas of AI, and so I think he's working on exactly the right things.
And that was NVIDIA CEO Jensen Huang speaking with our Ed Ludlow on Elon Musk's AI ambitions. Of course, in other AI news, NVIDIA teaming up with Uber to develop self-driving technology. Joining us now to discuss all things AI and EVs is Jon McNeill. Jon is the co-founder of DVX Ventures and the former president of Tesla. Jon, always a pleasure speaking with you. Happy New Year. I'm curious that when someone like Jensen Huang talks about NVIDIA's plans to work with Uber on self-driving technology, what kind of knock-on effect is there for other companies? How do you turn something that Jensen Huang says into useful insight for the industry at large?
Well, Happy New Year to you too, Scarlett. Thanks for having me. I think it starts for us where we think about what are the second-order effects of all this training and infrastructure that's being put in place for AI. And as we started to look through really through the infrastructure and supply chain, you end up obviously at data centers. And then if you look within data centers, there's a lot of talk and a lot of ETFs focused on the top 5 or 7 stocks that are typically the semiconductor stocks that go into these data centers. But when you break down the actual kind of bill of materials or what's actually in a data center, for AI, it's actually quite different than a regular data center. You've got massive memory need, you've got massive cooling need, obviously massive electrical power need. And one of the interesting tidbits that we dug up is that there's about 4 times the amount of fiber in an AI data center than there is in a typical data center. And there's a company like Corning that makes that fiber. So we built up an ETF that really reflects the entire supply chain around the AI infrastructure so that the average investor could get in and really benefit from where the profit pools are. The profit pools are generally in the supply chain, not in the end producers. And we wanted to make sure that we were tracking the right tech, finding some of these hidden gems, and then weighting it right in terms of the amount of upside there is in some of these stocks based on what is happening over the next 3 to 5 years in this infrastructure build out. That's really exciting.
So I'm looking at the ETF, AIS is the ticker here, and the top geography is the U.S., primarily because of NVIDIA. But after that, 16% is weighted in Taiwan, about 6.5% in China. That raises the question of tariffs and the risks of investing outside the U.S. when the U.S. has proven to be such a haven over the last couple of years.
Yeah, I think the U.S. is clearly a big market where there's a lot of investment happening. But as you mentioned, there is investment happening in other geographies. And Asia is not going to be left behind in this AI race. And they're building AI infrastructure as fast as we are. And so we wanted to reflect the international footprint of the supply chain, not only for U.S. Data centers, but for the data centers that are being built in Asia that are not going to be subject to U.S. tariffs. Those are AI data centers for Asia.
Absolutely. And John, it gets to this idea, though, too, when we talk about how all this stuff gets dispersed, I mean, meaning on a geographic level here, is the U.S., I mean, I guess from an economic standpoint, can that sort of cost benefit be better here than somewhere else?
That's a really great question. I think to answer that question, we need to start to see some of these AI applications really start to generate value. And Jensen, in his speech at CES and in his interview with you, is really highlighting a couple of those. And where we're seeing value that's being created already. If you live in San Francisco or Phoenix or LA, you can take an autonomous car ride. And if you're in manufacturing, you're already seeing the development of robotics and how that's going to impact manufacturing going forward. Those are 2 examples of maybe the first AI applications that are going to be massive. Mm-hmm. If you combine the AI in robotics and the autonomous driving, that's potentially a multi-trillion-dollar AI market, as Jensen noted last night. Yeah. And I think that's where a lot of value is going to get created. You're going to start to see the ROI on these massive investments.
And we're in conversation right now with Jon McNeill over at DVX. And I just want to point out to our viewers, we have some breaking news crossing the wire on Amazon regarding data centers. Amazon Web Services, of course, the big profit driver of that company, saying that it's going to invest $11 billion in the state of Georgia, primarily to support cloud computing and AI technologies, i.e. Data centers here, saying it's going to create at least 550 new high-skilled jobs. And John, I want to kind of pose this question to you. I mean, this is a lot of money for any company, but the idea that it's just concentrated just on Georgia, and we've had other announcements by Amazon Web Services of investments in other states. You have other big companies like Microsoft and a few others also making these announcements. This is a lot of money, John, going around right now. You think that's going to continue, or more importantly, do you think that's going to increase from what we already know?
I think when you see the announcements from Amazon like this, from Microsoft the other day, where the heart of Microsoft's announcement was that they were going to invest at least at the pace that they're investing in now. And this is a real arms race in the sense that the compute is needed to solve these problems. Somebody's got to provide the compute, and the hyperscalers in the form of Amazon, Google, and Microsoft are at the forefront of this race. And so you see these really substantive and material CapEx announcements that I think are going to continue and probably grow.
John, we'd be remiss if we didn't, press you more on electric vehicles, given that you were the former president over at Tesla, and we talked about self-driving vehicles. That's going to be a 2026 story, if you believe Elon Musk's projection for robotaxis and the production of that. Before we get there, though, we need to right-size the EV market first. And the legacy car makers, they're paring back production, and in some cases they're merging, like Nissan, Honda. Does the cost-cutting for this industry peak in 2025, or will this be a multi-year process, something that'll take us into 2026, 2028?
It's a great question, Scarlett. And I think if you look at the automotive industry globally, as a whole, there's about 20 to 25% overcapacity in the industry. So that means that we're going to continue to see consolidation of capacity, and not just in 25, but in years beyond. To answer your question, I think what's at the heart of Honda and Nissan coming together is they've really missed the boat on EVs and cost reduction. So they're in a very difficult spot to go it alone, and need to come together to really take significant cost saving steps. And I think we're going to see more of that, not less of it, because the Chinese competition is real. They've demonstrated a very different cost level. And internationally, the automotive manufacturers are going to have to step in to both EVs and cost cutting.
Given the new administration coming in here in the U.S., John, do you think we're going to see an acceleration of this, meaning the government will sort of clear the way for this to happen faster?
I think to the extent there's consolidation in the U.S., it'll be easier, I think, under a new FTC chair for sure. But there are several American companies, including GM and Tesla, that are in good shape to battle both on the low cost and the EV front.
All right, John, got to leave it there. Always a great conversation. Jon McNeill, the co-founder over there at DVX Ventures. Scarlett.
All right, let's just give you a recap on how markets closed on day. Big sell-off in equities, big sell-off in bonds in particular. A lot of red arrows there. You can see the yields moving higher on the 10-year and the 30-year. There's a $39 billion sale of 10-year notes. Not great, drawing the highest yield since 2007. You could see the 10-year yield reaching 4.69%, getting close to that 4.7% level. The 30-year yield now at the highest since November of 2023. And look at that, 1% plus declines for the S&P and NASDAQ.
We'll be back in a moment. This is The Close on Bloomberg.
It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Mark Carney, former governor of the Bank of Canada and Bank of England, says he is considering entering the race to replace Justin Trudeau as the leader of the Liberal Party in Canada. My question is why? Because there's going to be an election shortly thereafter.
Yeah, well, I think the idea, though, too, is that if the Liberals are looking for somebody that maybe could actually beat out the Conservatives in a couple of months, maybe he is. I mean, he is kind of the ultimate statesman. He has a lot of jobs, including, of course, sitting on the board of the company that owns the network that you're watching right now, Scarlett.
Still, we're talking about polling where they're trailing by 20 points.
Mark Carney, keeping an eye on him. I'm keeping an eye on Hulk Hogan. You remember him, Scarlett?
Oh, yeah, 80 star.
Last night, Netflix, of course, is rolling out all these live sports. They finally debuted the new Raw, the WWE Raw program. Hulk Hogan was a big feature of that, except he actually got booed. No one likes him. He was coming out there. He was pimping some, beer that he's doing, some light beer that he's doing. He had the whole Real American song, and everyone's booing him. Remember, he was like the hero back in the day, and now it's like, everyone's like, give me somebody else.
You know what? Not enough Gen Xers there.
Yeah.
That's what it comes
But I like
down
the touch there. I watched part of this. He rips off the shirt, and he's got the Netflix shirt underneath it. That's great.
Well, he's the ultimate showman, right?
He's something.
All right, speaking of showmen and showwomen, let's talk about the last folks in our top three.
Is that
Ben
Jerry Hart
Affleck and Jennifer Lopez.
Oh, wow, I didn't know he was still alive.
The two officially settled their divorce, according to reports. They had been separated for a long time. Of course, they have a $60 million mansion in Beverly Hills that they're still selling.
You said 6Z?
60.
Oh.
And I think it's north of that.
Okay.
60, I'm rounding down here.
All right, well, it's good to be Ben Affleck and Jennifer Lopez. Even if they're not together, that crazy couple Wow, mazel tov.
They did spend some time over the holidays together in that their kids were having play dates, but never mind. That's another story.
All right, another person we're keeping an eye on. Well, his name is Robert Hanson. You probably heard of him. He was the former Constellation Brands executive, has had a long career in the retail space. He's now set to take over a new venture, the wine company, the Duckhorn Portfolio. That announcement being made today following the completion of an acquisition of Duckhorn by Butterfly. It's valued at more than $1.9 billion, and I'm pleased to say we're now joined by the incoming CEO of Duckhorn, Robert Hanson, and Adam Waglay, the co-founder and co-CEO of Butterfly. And Adam, first of all, congratulations to you, Robert.
Thank you.
I am going to start with Adam, just because Butterfly has been doing a lot of exciting things, and I think kind of set the scene for our viewers. You guys have an investment thesis that is firmly rooted in the idea of, I guess, food consumption, if you will, food and beverage consumption, things like that. What made you sort of venture down into the world of alcohol and wine?
Yeah, so maybe just to level set, we are exclusively focused on the food and beverage space, which is a $26 trillion space. It's the biggest industry in the world. It's the highest growth industry in the world. But we don't stop there. Within that, we're looking for the best and most attractive places to play in food and beverage. And wine is very appealing, and in particular, the segment of wine that Duckhorn plays in, which is luxury and premium, is where all the growth's been. In the last 12 years, we had a 7% growth in that sector, and in that $15 to $50 a bottle. So we're in the right area of growth, but also a really interesting business model. So this is a business that sources 90% of its grapes from third-party growers versus growing them directly, giving it a very flexible business model and a very attractive EBITDA margins.
I am curious. This is a huge investment, but probably even bigger than that is that somehow you can manage to convince a big executive like Robert Hanson to be by your side. And Robert, I mean, this seems like a dream job for a lot of folks. What's the comparison between running Duckhorn, I know you haven't officially started, and running something like Constellation Brands?
Well, I would say Adam and the Butterfly team. Let's start there. I've known the team members of the team for about a decade. I have gotten to know Adam really well over the past 10 months or so. He says it feels like 5 years, given how much work we've been doing together. But what Adam described is really what attracted me to work with Butterfly. They have an ethos which is very consistent with the Duckhorn portfolio. They believe in doing business in the right way. They're a seed to fork, and we're a farm to bottle business, and so you have to care about how you bring products to market in the best interest of the consumer, the environment, and our customers. So there's a good connection there. But I am really excited about this portfolio. It's beautiful wines, Costa Brown and Duckhorn vineyards on the luxury side, Sonoma-Cutrer and Decoy on the premium side, among other brands in the portfolio. Clearly where the category is winning is in the $15 and above segment. Adam mentioned the 7% growth rate over 12 years. What is exciting about this portfolio is, given the quality of their wines, leaning into the consumer trends, the disruptive way they've introduced innovation to the market, this portfolio has contributed about a third of the total growth in the 15 and above category over the past few years, and we're looking forward to continuing that.
Robert, just to follow on what Romain was asking, to compare and contrast working for a private company versus a publicly traded one, what will being private allow you to do that you couldn't, you think, at Constellation Brands? I mean, in terms of strategic investments, in terms of time horizons for what you want to achieve?
Well, the Butterfly team and I, and Adam's been heavily involved in this, have been working for 10 months on the investment thesis. And what I think, Scarlett, is important is to be able to execute in the short term and keep your eye on the medium to longer term transformation of the portfolio. We see the growth opportunity here in multiple segments of business opportunity. There's organic growth. It's a beautiful portfolio of core 4 brands, but 11 in total. There's innovation opportunity as well as distribution expansion. In addition, the business is underpenetrated in direct-to-consumer. It's about 12% of the business. It should be much more than that, given the quality of the portfolio. International is only about 6% of our business. It should be much bigger than that. And these are all the types of investments that Butterfly keeps their eye on, is like, what can we do today? Day one focus is organic growth, but what are the incremental opportunities? And then, of course, with their strategic and investing capability, but also their operating capability, they'll bring the capital to bear to help us grow the business over time consistently, which is exciting.
Adam, as we look at the food and beverage space overall, what consumer trends do you think people don't quite appreciate, have underestimated, that are taking place, and we'll start to see incremental payoff, incremental dividends?
Yeah, outside of wine, as we've been talking about, I mean, I think some of the major trends are people are consistently looking towards food for function. Things that are going to get them more protein, going to bring hydration, going to bring other kind of benefits, calming, relaxation, stuff like that. And there's so many ways to play that trend. So I'd say that's one major one. Another one that we're very excited about as well is ethnic flavors of various different kinds. I think with social media proliferating and spreading trends all around the world, I think people are now getting more adventurous and trying different types of things. And there's many ways to play that. It could be the manufacturing of those types of ethnic products to actual brands that are selling them, to restaurants that kind of play into that, where Qdoba in the Mexican space is an example, or various different Asian concepts we've looked at. So I'd say those are two kind of major ones that maybe aren't as intuitive that people aren't thinking about.
I'm curious, as you structured Butterfly, was the idea for all these businesses to be complementary to each other or to stand alone?
Yeah, so at our size and scale, so we're about $6 billion under management today, and we've got about 11 companies. The intention was to build them, separately to begin, but we're already starting to see them collaborate in various different ways. So as you can imagine, with a portfolio selling, $6.5 billion in revenue to a lot of the same retailers across a lot of the same kind of restaurants. With very similar kind of manufacturing techniques and things like that. So we're starting to see a lot of our portfolios collaborate in various interesting.
Well, that's why I was curious, Robert, whether you're going to see wine pairings between Duckhorn and some of the other food properties that Butterfly has.
I mean, there's a lot of connection, obviously, as Adam said, across their portfolio. What I particularly appreciate about Butterfly's focus is they're really focused on the premium sector and the better for you trend in terms of consumption. I think in wine, it's true that consumers are leaning into lower quantity of consumption, but a higher quality of consumption. And we've always encouraged consumers to drink in moderation, but the alignment here about better for you consumption is something that it correlates across the portfolio. And the reality is this portfolio is predominantly high quality premium and luxury wines, so it leans straight into that consumer trend. We like to meet consumers on their playing field, on their terms. And this is the spirit of what I think Adam and his team at Butterfly founded the business on.
So Robert, is there a meeting people where they are when it comes to non-alcoholic beverages? Is there room for that in your portfolio?
At the moment, we have decided to participate in the lower alcohol and lower calorie category. One of the biggest and most successful innovations in the wine category has come from this portfolio on our Duckhorn brand. We did an extension called Decoy brand. We did an extension called Decoy Featherweight, which is lower alc and lower calories. So meeting the consumers on that field, but we are definitely looking at lower alcohol and even zero alcohol, as long as the craft and quality can be met. So sensory is the most important thing. If you're going to put something across your lips, it's got to taste amazing and meet your more functional needs as well.
I am curious about the business model with Duckhorn. You mentioned at the top here that the majority of your grapes are sourced from third parties. Here, is that an advantage, or do you need to have a little bit more control over the vines, or does that not matter anymore?
Yeah, let me take it, and then I think Adam probably would add an investor focus. What we love about this business model is that they source 90% of grape, or Duckhorn Portfolio sources 90% of its grapes from partner growers. This helps us in many ways. One, it's agile. You can't deny the impact of climate change, for example, and so we have the ability to source the highest quality grapes from our grower partners, depending on what's happening in the climate. The second thing is that it enables margins to be really quite substantial for this category. The wine category has been a capital-intensive business. This is a low capital asset-light model, and so it's very appealing because it's got flexibility, but it also drives a return on invested capital focus that I think is the envy of the industry in a lot of ways.
Yeah, perfectly said. I'd just add, double underscore the margins are high, but also you don't have to invest the capital. So just from a return on capital standpoint, it's very compelling, and also managing risk, right? You're not doing all the farming and everything else.
Wonderful. Thank you so much, gentlemen, for joining us today. We've been speaking with Adam Waglay. He is co-founder and co-CEO of Butterfly, and Robert Hanson, incoming CEO of the Duckhorn Portfolio.
Yeah, a great conversation there, a focus on what's been going on in the wine and beverage sector. Meanwhile, we turn our attention now back to Washington. President Jimmy Carter, the 39th President of the United States, his casket arriving at the U.S. Capitol Rotunda, where he will lie in state, where folks can pay their respects ahead of his state funeral on Thursday in Washington, D.C. The horse-drawn carriage there, bringing his flag-draped casket to the Capitol. A proper goodbye for the 39th President of the United States of America. A push ahead to what the markets will have their eye on over the next 24 hours. About 24 hours ago, it was NVIDIA CEO Jensen Huang. Later tonight, it's going to be Samsung and their earnings.
Yeah, Samsung Electronics competes with Micron and SK Hynix in those high bandwidth memory chips, and it's going to really set the tone for what happens with the chip stocks.
A focus on chips tomorrow. There'll also be a focus on the Fed and economic data. We're expected to hear a speech from Fed President Waller.
Yeah, he's going to talk about the economic outlook, and of course, that kind of sets us up for the Fed minutes later on in the day. That hawkish cut where, we did get one dissent.
That comes out at 8 a.m. That speech is scheduled to start at 8:15. We're going to get the ADP jobs report, followed by the jobless claims numbers from the government, the weekly jobless claims at 8:30 a.m. Eastern time.
Yeah, another high-frequency data point in the lead-up to the jobs report on Friday.
We're also going to get an interview with Alcoin SEC Chair Gary Gensler, who just has maybe another week or so on the job. Bloomberg's David Gura will be sitting down with him. And let's talk about those FOMC minutes. Are we going to learn anything?
Well, I mean, we'll get more details on the dissent and perhaps how many other people were leading in that direction.
Of course, this has been a big driver of the markets. We'll have full coverage of that tomorrow here on The Close. Thanks for watching us. We'll be back tomorrow. This is Bloomberg.